Good day. It was an honor to be asked to present to you today, and specifically, I'm going to be discussing with you a specific exit strategy called Employee Stock Ownership Plans, or ESOPs for short. To tell you a little bit about myself, I've been working with privately held businesses on exit strategies, whether it's private equity transactions, selling to strategic buyers, interfamily transactions, sales to insiders, including management and ESOPs, dating back to 1993. I originally came to Indianapolis to work for Eli Lilly in 1990 after graduating from the Darden School of Business at the University of Virginia. And I stayed with Eli Lilly for 3 years before going into investment banking to specialize in working with privately held businesses. So I've been working with employee stock ownership plans. I'm going to refer to it going forward as ESOPs since 1993, and I've been privileged to have been involved in hundreds of transactions across the United States and here in Indiana and Indianapolis specifically. An ESOP is a qualified retirement plan, but it's a qualified retirement plan that, as I've indicated, is primarily used in conjunction with an exit strategy. So what I first want to just discuss is all of the various opportunities for shareholders as they are considering exit strategies. If a company is not doing well, a lot of times we all have heard that companies do not make it beyond the first generation. So we have businesses that simply liquidate. For profitable businesses, especially larger ones, sales to private equity firms, sales to strategic participants within the industry is an excellent alternative. Many companies transition to other family members or management teams. And in that regard, we have different ways of doing that, such as gifting, installment sales to family members, things of that nature. An ESOP, generally speaking, comes within the category of selling to an insider. In this particular case, you're selling to a trust and the beneficiaries of the trust. So what makes ESOPs very attractive is the tax benefits that come with being a qualified retirement plan. But when you're going to take advantage of extremely significant tax benefits, you're going to have to be compliant with those parts of the government that regulate qualified retirement plans. Now, in this particular case, we have ERISA and we have the tax code. So when you're looking at doing an ESOP, we have to make sure we are in compliance with ERISA and the tax code. In addition to having tremendous tax benefits, especially before COVID, a little more subdued since COVID hit, but banks are very interested in lending in support of ESOP transactions. Many of the banks that you are familiar with, Fifth Third, PNC, JP Morgan Chase, have created ESOP lending groups. So they are highly familiar with these types of transactions and they want to lend. Now, as specified, in 2020, the credit conditions have not been as good as they have been in prior years, but we are certainly expecting a resumption of increased activity as we move from 20 to 21 and we get some of the issues of 2020 behind us. Some people worry and say, if I do this ESOP, if we become 100% ESOP, it sounds great. We have a lot of tax benefits helping us, but I really don't understand it. Who controls the corporation? How do things work? Do the employees get to dictate how the business is run? Do they get access to financial statements? Do they know what other people are making? The answer is no to all of those questions. The ESOP, the stock is held in a trust, and the employees are beneficiaries of the trust. There is a trustee that represents their interest. The only thing that the trustee is responsible for are ERISA fiduciary decisions. The governance of the corporation, the daily running of the corporation is held by the board of directors and the executive management team. How future board members are nominated and selected is created in advance of doing an ESOP transaction. So you thoroughly go through your board of director nominating policies, procedures before you do the transaction. Once the ESOP is in place, the board of directors are making the key decisions as to how the corporation is run and the strategic decisions that are being made. If you stop and think about it, most corporations that do an ESOP, an employee stock ownership plan, have board of directors that most of the members are from inside of the corporation. And the last thing a trustee would ever want to do is get in a situation where there's an adversarial relationship with the board of directors, because the trustee is not the industry expert. The trustee does not have the managerial expertise to run the corporation. So the trustee wants to have an extremely symbiotic relationship with the board, a very complementary relationship, a very amicable relationship. It needs to be a team approach. And as you look at ESOPs across the United States, and if you do research and talk to companies that are 100% owned by an ESOP, I believe what you will find is that in the vast, vast majority of the cases, the trustee is submitting to the decisions that are being made by the board. Now, there is a discussion of as board members come off and future board members come on, who is going to replace that. And I believe that what you'll find is that in most cases, the ESOP trustee will agree to the recommendations of the existing board as long as those are prudent recommendations. So if we have a follow-up meeting, we could talk more about corporate governance and control. But for the purpose of this summit, for the purpose of this presentation, I think it's important to say that the control of the corporation pretty much stays with the board of directors, which is why valuation firms such as mine have stopped a long time ago putting in a discrete control premium into our valuations. So that is important. So if you are considering an ESOP, if you've heard about it, if you think the tax mitigation can play a significant role, please know that you don't really have to be worried about control. And again, if that is a topic that you would like to discuss further, we could discuss it in a private setting after this summit. I'd now like to move to how the transaction works. Let's say you want to do a 100% ESOP transaction from the beginning. And let's assume that 65% of the funding of the transaction is going to come from a bank or outside investors in a bank. and then 35% is going to be seller subordinated debt. Those parties will lend to the company. So in the first transaction, you will have a loan from the investors, mostly a bank, to the company. The company will then lend to the newly formed ESOP. Now, in the world of ESOPs, the proper vernacular for the relationship between the outside investors and creditors and the company is called the outside loan. The loan from the company to the ESOP is referred to as the inside loan. And here's what's important. As you go through this process, the reason it's done this way is to create flexibility. And again, I can't cover all of this within a 30-minute period. So if this is of interest to you, we can discuss this in more detail in a private setting. But for now, let's leave it at the fact that the reason that there's this inside loan and outside loan is for the purpose of financial flexibility, and it's the way that virtually every ESOP in the United States is done. When the funds go into the ESOP then cuts the check to the selling shareholders, and now they have the money and they tender their shares to the ESOP. At that point, the investors can do what they want with the proceeds, but if they want to indefinitely defer and potentially eliminate capital gain taxes, they can take advantage of a section of the tax code called Code Section 1042. And in doing that, it's very similar for those of you who are real estate investors. It's very similar to Section 1031, in that if you take the money you receive from the sale to the ESOP and you invest it in qualified replacement property, which in this particular case, for the purposes of 1042, is American stocks and bonds, American corporation stocks and bonds, then you can indefinitely defer your capital gain taxes as long as you hold those replacement securities. And then at the time of death, you would get the step up in basis, and your heirs could receive that portfolio, and you will have never paid capital gain taxes. So let's quickly talk about that. So for example, let's say you're in your 60s. You want to do a 1042 transaction, and you're going to work with your registered investment advisor to create a portfolio of high quality, good dividend paying stocks. Let's name a few. Procter & Gamble, Sherwin-Williams, banks like Bank of America, or JP Morgan Chase, an insurance company like Aetna, all different types of companies, industrial companies like Honeywell. You may want to go into some initially lower yield stocks like Microsoft, which have potential for significant growth. And that's what you would work with your financial advisor to do. And so after you do your transaction, that can become a core part of your portfolio to give you and your spouse and family members income in your retirement years. Then, if you don't sell many of those stocks, you don't pay the capital gain taxes, and your beneficiaries at the time of your death can inherit that portfolio. So many of the clients that we work with choose to fully take advantage of indefinitely deferring and potentially eliminating capital gain taxes. So once again, the money flows from the banks and other outside parties to the company, from the company into the ESOP, from the ESOP to you as the selling shareholder, and then you work with your registered investment advisor to put the money to work in investments. Now, what will happen is that after the transaction is done, the company puts a contribution into the ESOP. But remember now, there was a loan from the company to the ESOP. The ESOP owes the company money. So when it comes time for the company to make an ESOP contribution, let's say it's $500,000, the company will put that $500,000 into the ESOP. And let's say it does that at 9 a.m. in the morning with a bank, the bank that created the ESOP checking account that made the loan. Immediately, that contribution is used to repay the loan from the ESOP to the company. So the $500,000 goes right back to the company. And so you now have an employee benefit expense for $500,000. So just to reiterate what I had indicated, once you do an ESOP, if you've done a 1042 transaction where you're going to indefinitely defer your capital gain taxes, you did it probably for less than 50% of the corporation. You might be phasing into 100%. So then your tax mitigation while you're a C corporation under Code Section 404 is going to be important to you. And you're going to get very large deductions under Code Section 404. And again, we could discuss this on a private basis if you would like. Once you become 100% S Corp ESOP, then you no longer have to worry about tax deductions because you will be a tax-free entity at the time you become 100% S Corp ESOP. And again, a lot to go over in 30 minutes. Happy to spend more time getting into the weeds, so to speak, if it's of interest to you at a later date. What I'd like to turn to in my final segment now is how we go about helping our clients and how we work together with a team. First of all, what's important in a team? Well, I think at the top is you have to have a team that is going to do things and keep you safe. You don't want to have any risk of having any problems if the Department of Labor and the IRS is to audit you. And I am happy to say that I have gone through many audits with the Department of Labor over the last 30 years, and the Department of Labor has accepted all of PACE's valuations, all of the structures that we've recommended. Knock on wood, up to this point, over the last 30 years, we have a 100% track record. Our goal, what we strive for, is to try to meet the objectives of the selling shareholders, but do it in a way that's going to be a win-win proposition for you as well as the ESOP, and do it in a way where if the Department of Labor or the Internal Revenue Service was to audit you, you're going to come through in flying colors. And up to this point, we've been able to achieve that. So that's our top objective. Now, in addition to that, though, we do want to be creative and we want to be cost competitive. What we find is that there are many teams out there that come in and scare people away with how much the total costs are going to be. So over the years, we've put together a very detailed process. We think it's a process that helps business owners such as yourself learn a lot without having to commit any financial resources at the front end. And then as you move forward, having a process that takes you through closing in a way that, again, is expeditious, cost competitive, very thorough, and very integrated. So I want to go through that with you, and then that'll be our last segment of the presentation. First of all, we want to make sure before we really get into it that what we believe we can defend with the Department of Labor is consistent with your objectives and expectations. So we have 2 sessions, what I call the preliminary interview, where we're getting to know each other and seeing if we're a good match to work together, and what I call the discovery phase, where we're thoroughly understanding your company performance, your company's positioning, your balance sheet, your management team, your workforce. We really want to get to know you. And what we're doing is we're giving you a free verbal evaluation and a free analysis of how a deal might be structured using outside party debt and seller subordinated debt in those phases. So that by the end of what I call the discovery phase, you have a good understanding if you go to the next phase where we're doing a feasibility study and design analysis, whether it's going to meet your objectives. Because we don't want you to go to that phase if we don't think that we can do a win-win deal, one that meets your objectives, one that's good for the ESOP, and one that my firm, representing the ESOP and the trustee, working with the trustee, can defend in the event of a Department of Labor or an Internal Revenue Service audit. We want to defend that. And so when we go into that design phase, we are making sure you have a great understanding of the economics to you as a selling shareholder. We want to help you thoroughly understand the capacity of the company to meet the debt obligations as well as the repurchase obligations associated with an employee stock ownership plan. And we want you to thoroughly understand what this can mean to your employees. Now, we all know in America that many employees are not going to be ready for retirement. They're not going to have enough saved. The average ESOP balance in the United States is well over $200,000. So this can be a major benefit to your employees. And we want to show you in this phase what it can mean. By the end of this phase, the design phase, you're going to have a very good understanding of whether or not this is going to meet your needs. Then and only then do we ramp everything up. Do we get attorneys involved? Do we get the bank working on a commitment letter? Do we really push forward on writing a valuation report? And that's in the implementation phase. And my team and I believe, have a very good history of having that phase go smoothly, of being very coordinated, very collegial. Then you close the deal. And we want to help you in every way. We want to help you in the technical aspects of administering an employee stock ownership plan. We want to help you in creating the kind of employee ownership culture that you think is right for your organization. We want to help in terms of bringing third-party administrators and your CPAs and your internal personnel all together for a nice, smooth process every year. So we work with you after that in what we call the final stage, the management phase. And we also help you if you're potentially going to be considering other transactions in the future, get ready for that. And you can read all about this in our in our presentation that accompanies this. Finally, I just want to reiterate how integrated this needs to be. Why an organization needs to be a part of our team and working with your accountants, because We're looking at the business aspects of the transactions. We're looking at your personal aspects. You're doing personal planning and business planning all at the same time. There may be a charitable element that comes into play. Right now, I'm doing a very large transaction here in Indianapolis, and as part of the overall transaction, the client, the selling shareholder, wants to take 10% of his proceeds and put it in a donor-advised fund prior to the transaction being consummated. He wants to take another 10% of the transaction and put it in a charitable remainder trust. So there's a lot that's going on, and I love these overlapping circles. I love these overlapping circles that indicates we want to get these elements being done simultaneous, the business and the personal, so we can make sure planning for you is done in an optimal manner. So I feel like I've been long-winded. 30 minutes have gone by pretty quickly. I thank you for your attention. So to summarize everything, we're not here to sell you an employee stock ownership plan, but we do know that more and more companies are viewing ESOPs as a great alternative to private equity, as a great alternative to an inside management buyout, as a great alternative to a strategic sale. The economics can be great for you as a selling shareholder. It can be great for your management team. It can be great for the employees. All we want to do is help you digest information and make the decisions that are right for you. Again, I'm George Cassiere, the president of Pace Financial Group. If you would like to reach out and set up a private meeting, please contact me at my email address or our phone, and we could get something on the calendar and discuss things in a more detailed fashion that's particular to your situation. Thank you again so much for affording me this opportunity.